Well, India has always had a twin deficit problem, fiscal deficit and current account deficit. But the good news emerging now is that our current account is fast turning a surplus. And that's because of a sharp growth in services exports. Sample this. Service exports were at 204 billion in 2019 and they have now risen to 272 billion with only the first 11 months of FY23 counted. The key component in India's services exports continues to be, of course, software exports, which have grown from about 84 billion in the year FY20 to 109 billion in FY22. A smaller category called business consultancy services has grown from a minus 1.16 billion in FY20 to 728 billion in FY22, further to 8.6 billion in just first 6 months of this year. So this will possibly go to over 16 billion for the full year. Experts are guessing that perhaps part of this business consultancy inflows are from GCCs or global captive centers set up by foreign companies in India to process their middle office work, work like accounts, compliance, etc. Rising service exports are having a huge impact on India's overall balance of trade. India's merchandise trade deficit had shot up actually to about 25 to 30 billion a month because of high crude, fertilizer and commodity prices in calendar 22. But in 2023, not only is the good trades deficit shrinking because of lower crude and commodity prices, the surge in service exports is shrinking the overall goods and services deficit to just $1 or $2 billion a month, from a high of $10 to $20 billion a month in 2022. So together with the fall in goods and services trade deficit and a rise in remittances from Indians abroad, the country looks set to post a current account surplus in the ongoing Jan-March quarter. In fact, given the continued growth in services exports, India may report a current account surplus or a negligible deficit for the next few quarters. So the questions we are asking today is, will services exports continue to rise? And secondly, how does a current account surplus or very low deficit help policymakers in India, the Monetary Policy Committee, the Reserve Bank and the Centre, to boost Indian growth? To answer these, I have with me Megha Chawla, partner at Bain and Company, and Arindam Sen, partner at EY. They are going to speak about services exports and the GCC part. Sonal Varma, the Chief Economist from Nomura, will analyse the policy impact. Well, let me start with you, Megha, first. What is your sense about how much software exports and within them GCC are likely to do? What are the current trends you are getting through FY23?
No, thanks, Lata. We've actually, since COVID, we've seen an explosion in the effort that organizations are putting in transformation of not just technology transformation, but all associated business processes as well. So as part of that, a huge part of that has been just hiring talent required to drive these transformations. And when these transformations have happened, a lot of organizations in the US, in Europe, Australia have realized that the widest, deepest, and maybe perhaps the youngest talent pool is in India. As a result of that, there is a step change in how organizations have looked to India. Those who were in India have further expanded their presence. Those who weren't in India have been swift to set up a presence over here. And those who were on the fence and were testing the waters have decided to commit to India. This is both in the form of going to third parties to augment their workforce, to get expertise and capability to drive some of these transformations across the technology layer as well as the associated business processes, but equally in the GCCs, because a lot of organizations are realizing that this is fairly core to their business. And while third parties are a very important part of their ecosystem, their business ecosystem, not having their own centers leads to a bit of a loss of control and a loss of ownership over fairly core capabilities across each of these areas. So we've seen this take off. Interestingly, the underlying trends behind this takeoff are not temporary. Okay. Right? These are transformations that every organization is going to have to undergo. The relative advantage of India, which has always existed, but has now intensified given technology and some of the domains that we're talking about continue to acquire more importance in the organization. And finally, it's a younger population.
No, I take your point. So these are structural issues. Demographics in Europe and US versus India, and the fact that, work from home or remote is now way more acceptable after COVID. Arindam, until now we have heard of outsourcing in banking. I mean, banks always did that, call centers, etc., as well as, processing. And we heard it in IT. Is it now expanding into non-financial as well?
It is. And I think what we are seeing is, there's two aspects to this outsourcing. GCCs is really, as Megha was saying, a company's own center where they have their own people and then generally augmented by partners. And then there is a outsourcing that happens from the GCC itself to third-party partners that help them either in large transformations or augmenting their teams. So overall, I think as GCCs itself are growing in the country, so is their spend within the country, especially when it comes to outsourcing spend and tying up with partners.
Okay. So just to finish that argument, Megha, what do you see as growth numbers? What is the pace of growth? I think NASSCOM's latest numbers say that they are expecting, a 10 to 12% CAGR in terms of GCC growth itself. But if you can give me an overall services comment.
See, that sounds about right? Today, our services exports are in the range of about 180 billion. I think NASSCOM publishes that number fairly frequently. We've seen the services growth to be in the 15% plus range in the last couple of years. Secularly, for GCCs as well as services, we expect growth as well as hiring to continue that trajectory. Having said that, in the next couple of years, there's going to be a temporary impact which just reflects the overall global economy. But like I said earlier, this is secular. We expect this growth to continue both on the revenue, the expansion within India, more organizations coming into India, the expansion within India, and the accompanying hiring that's going to happen.
Okay. You would agree, Arindam, that we are likely to see a continued growth in services exports?
We are, and I think it's happening right here, right now. It's been happening for the last 18, 24 months. There's a strong push to set up more and more capability centers in the country by various organizations across different sectors. So we are just seeing this huge, strong push given the stability of the environment, the fact that other companies have already established centers and grown them to a maturity level that is acceptable. People are seeing this as a huge potential to set up their own centers and take this forward. So even for us, we see this, continuing at least into the next 18, 24 months. And as you cited the NASSCOM report, I think anywhere between 400 to 500 new centers will come up by 2020.
No, in percentage terms, what? Would it be 12, 15, any number that you would internally have in mind?
I think anywhere between 10 to 15% in terms of sheer number of centers, because the numbers already today are about 1,500.
Got it. Okay, Sonal Varma, now for the macro picture. Would you believe, therefore, that because the services exports have done so well, we are going to be in a current account surplus, not just for this quarter? That is a given. It might even continue.
It's not our baseline projection right now, Lata. I think a lower deficit is what we are working with right now. I think there are various moving parts. Now, on the services side, of course, there's a structural uptrend that has continued, and we are seeing more broad basing of that. We need to bring in the current turmoil in global financial system and what it means for services growth rate going forward. So we might see a moderation. It is a more resilient category, but even there, you will see a moderation from a mid-teens to probably some single-digit number in the next, I would say, 12 to 18 months. The remittances component typically, grows as the currency depreciates. But if there is some impact on US tech jobs and oil prices come down in the Gulf countries, you will see like a mixed bag impact on the remittances component. On the rest of the current account, lower oil prices, of course, helping us to the extent the global slowdown spills over into domestic imports will come down, but exports on the goods side are likely to contract even further. So ultimately, it's the net impact of all these factors. I think what is very clear is the challenges on the current account are a lot lesser than one had imagined. As I said, right now, we're not expecting the surplus to sustain, but a low deficit definitely opens up the policy wriggle room to focus on many other issues.
Which brings me to your report, which was a bit sensational. One of the first ones to say that definitely RBI will pause in April. Now, to scratch that point further, if you see these service exports doing very well and the current account, month after month, the current account looks comfortable, does that give the Reserve Bank more wriggle room? I mean, even if there is global turmoil, the rupee is not that much in danger, so we can go ahead with decoupling. I mean, even if ECB is 50 basis, we can pause. You think they can take that call? You expect them to take that call?
Well, our view is they are likely to pause. Nothing is definite in life. But I think if you look at the Indian monetary policy, in any case, has been relatively decoupled. And the reaction function has been driven more by local dynamics rather than FX. So the view on the pause that we have is less to do with FX and more to do with the macro outlook. Now, I think on the macro outlook, we did get an upside surprise on Jan-Feb CPI, but a big part of it is statistical serials, which has got nothing to do with monetary policy. In our view, there are early signs that underlying inflation is moderating, so YOYs are still high, but the super core measure, which is core CPI excluding the commodities, we are seeing the run rate actually closer to 4.5–5%, even though YOY is running at 6+. I think monetary policy works with long lags, and given we've seen an effective tightening of 325 basis point, forward-looking inflation outlook we think will surprise on the downside. So we expect inflation to average around 4.8–4.9% FY24 versus the 5.3 the RBI has. And growth, we think these spillovers from global shocks are not internalized in India's growth projections. So vis-a-vis the RBI's projections of 6.4, we think it'll end up being closer to 5.3. So you put all of that together, I think the case for a wait and watch to assess the impact of the policy is the right next step in our view.
Okay. Well, that leaves a lot of questions on the table in terms of, what will the impact be on the currency if the Reserve Bank were seen to be different? And separately, whether the services exports, if the number is so mind-boggling, the market will be able to, withstand that kind of a different decision from the Reserve Bank. Those questions after the break, we have to take leave from the Bazaar viewers, but you will be able to see the entire show afterwards, after market hours today. After the break, the Bazaar viewers will get to see Chartbusters.
Brought to you by HDFC Life. Sar Utha Ke Jio.